Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at two regional financial giants, who would have reported fairly impressive results for their half-year and 9-month periods, respectively. We're speaking, of course, about Guardian Holdings Limited as well as NCB Financial Group. Now, both groups again reported improved performance on the heels of some fairly significant discontinued operations or one-off items, whereas excluding those items, results would have been relatively stable. Now, let's take a look at what those financial results would have looked like and what investors might expect in the coming months ahead. Turning firstly to Guardian Holdings Limited, or GHL, well, for that period ended June 30th, 2025, 6-month period rather, the group would have reported an earnings per share figure of $4.50 per share, which was a whopping 160% increase from the $1.73 per share recorded in that prior comparable period for 2024. Excluding or focusing on earnings per share from continuing operations and excluding that one-off extraordinary gain, there would have been a modest improvement in terms of EPS from continuing operations of 0.6% from $1.69 per share to $1.70 per share. Driving this performance from an operating perspective was insurance service results, up 5.9% from $402 million to $425.7 million. Ultimately, net income from all activities increased 1% from $952.6 million to just under $962 million. Overall, operating profits actually declined modestly, about 3.2% from $495 to $478 odd million, with profit attributable to equity holders ultimately, including that one-off transaction, improving 160% from $401 to just over $1 billion at the halfway point of the fiscal year. Now, that one-off transaction in particular was related to the sale of one of its subsidiaries, Toma, out of the Dutch Caribbean, I believe. Now, as we move to operating profits by segment, we can see that there were some notable changes. The LH&P segment, or Life, Health and Pension, would have declined in terms of contribution to profit before tax from $463 to $416.5 million, a 10% odd decline. On the other hand, Property and Casualty did improve by 35% odd from $129.7 million to $174.7 million in that orangish color. Insurance brokerage also slipped a bit, down 10% from $19.2 million to $17.3 million, while asset management actually fell by just about 50% in terms of PBT contribution for over the comparable periods rather, from $31.6 million to $15.2 million. So certainly some changes in terms of PBT contribution within the GHL group, but ultimately overall, including eliminations and adjustments, down just about 3.23% over the comparable periods. Now, from a valuation perspective, we can see that it is relatively good news for investors in GHL with respect to the book value, which would have climbed at the half-year point to about $23.58 per share on a price per share or book value per share basis, which is the highest valuation that it would have hit in the past 5 comparable periods, with some volatility in price movement on the stock exchange. Of course, over the stock exchange, that price to book ratio would have fallen from as high as 1.6 times at the half-year period of 2021 to currently 0.6 times, which is often interpreted as an indicator of value for potential investors in a particular stock, particularly in the financial services sector. So at a price of $14.50, Guardian is trading at a price to earnings ratio of just about 4 times, well below a sector average of 11.4 times, with a dividend yield of 5.5%, significantly above the sector average dividend yield of 3.2%. So with those higher insurance revenues in mind, relatively attractive valuations, and an appealing dividend yield, Bourse is maintaining its overweight rating on GHL for the time being. Turning very quickly to NCB Financial Group, well, for the fiscal 9-month period for NCBFG ended June 2025, the group would have reported an earnings per share figure of 34 cents per share, a whopping 56% increase from the 22 cents TT equivalent recorded in that prior comparable period of 2024. Driving this performance again was net income from banking and investment activities, up 21.7% odd from $4.04 billion odd TT equivalent to just about $4.9 billion TT equivalent. Profit before taxes ultimately increased at 64.4% odd from 974 odd million to just about 1.6 billion TT equivalent, with profit attributable to equity holders also increasing that 60 odd percent from 517 odd million TT equivalent to just about 830 million. Again, baked into this particular overall financial result rather was that one-off gain, which would have filtered through into NCBFG's financial results as well. When we take a look at segment performance in terms of profit before tax contribution, we can see that one-off gain very starkly highlighted in the LH&P segment with an increase in PBT from 796 odd million in the prior comparable period to just about 1.35 billion TT equivalent in the current 9-month period for 2025. A 70 odd percent increase. Wealth asset management and investment banking increasing about 86 odd percent from 105 to 196 million. General insurance also increasing 47 odd percent from 243 to 358 million, and treasury and correspondent banking rounding out the 4 largest segments in terms of PBT contribution, increasing just about 3.7% from 424 to 440 million TT equivalent. So we can see there a mix of some improved operating results as well as the impact of that one-off transaction for NCBFG. Now, from a valuation perspective, NCBFG, with respect to its price to book ratio or market to book ratio, is trading at the lowest level of its banking sector peers, and certainly well below the sector average of 1.2 times price to book. It's trading at roughly half of that, at 0.6 times price to book. Perhaps an indicator of value, perhaps an indicator of lower investor sentiment at this particular point in time, with, of course, news articles surrounding the ownership structure of NCBFG coming to the fore in recent weeks. However, again, from a valuation perspective, 0.6 times in terms of a market to book value is at the absolute lower end of the price to book ratio spectrum. At the highest end, for example, we have Scotiabank Trinidad and Tobago, which is trading at just about 1.8 times price to book. So at a price of $1.91 per share, NCB is trading at a price to earnings ratio of just about 5 times, which is well below the sector average of 9.8 times. But of course, included in this low valuation would be that one-off gain, which would have occurred in the fiscal year, and NCB currently offers a trailing dividend yield of 3.3%. Below the sector average of 4.9%. So with those higher banking and investment results in mind, improved insurance service results from and stable operating results, but of course, keeping in mind that this performance and current valuations are impacted by that one-off valuation, excluding the attractive price to book multiple, Bourse is maintaining a market weight rating on NCBFG for the time being with a stable outlook. Well, that's it for this week's edition. For more information, you can give us a call at 2-Bourse or 226-8773. Email us at info@boursefinancial.com. And of course, you can check out our website, bourseinvestment.com, where all of our research is absolutely free. And you can catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. So until next time, stay safe, happy investing, enjoy the opening day of school, and we'll see you again on the Bourse Reports.